In this AMT Insight, I'll be reviewing current copper price trends and drivers and trying to give some thoughts on the future outlook for the market. To review where prices are now, LME copper hit all-time highs of $10,840 a tonne in early March, triggered in part by Russia's invasion of Ukraine at that time. Since then, the price has pared gains amid LME liquidity issues. Investors have been pulling back from the LME because of the heightened volatility recently, because of the issues in the nickel market. In addition to that, we've seen some rising headwinds to global growth, which have perhaps dampened some sentiment in terms of prospects for consumption for copper and other base metals. Now, if we look at copper demand, there's some clear short and medium-term risks. China's zero COVID approach and its fresh wave of new lockdowns, combine that with property sector weakness it's been experiencing over the last 6 months or so, I think are really likely to have hit domestic economic growth in the first quarter of this year. And that might even intensify in the early part of Q2 because of the intensifying lockdowns we've seen in places like Shanghai in the last couple of weeks. However, copper consumption may ultimately benefit from the reactive policy support that Beijing has promised for financial markets, for the property sector and fixed asset investment. That might take a few months to feed in. Maybe it takes a few months for these zero COVID measures to kind of ease off as well as that. So perhaps in a few months' time, we might see a little bit of support coming through for copper demand from that perspective. However, China is also reliant on strong export demand. It's been very reliant on that to sustain its economy more broadly over the last 6 to 9 months as domestic consumption has remained very weak. And copper specifically, it's quite reliant on, in terms of its supply chain, on equipment exports, in terms of housing appliances, finished goods, that kind of thing. Now, the issue with that is that the ex-China growth picture is looking a bit shaky too. So there's been a real shift from Europe, US, UK. The focus really had been on before, we need to boost the economy, we need to help it recover from the pandemic, easy policy, low interest rates, etc., etc. Now it's really changed. There's been a shift in focus to we need to do something about the really strong inflation and price pressures that have come as a result of that. So the shift has changed, and the difficulty there is that there are these pressures on growth from tight labour markets, from high energy prices because of the situation with Russia and Ukraine, and these growth risks. The economies can't address them that easily now in the same way they would normally in response to a major shock because of high inflation. They can't ease policy in the same way. They have to keep focused on trying to control these price pressures. So the result of that is we are likely to see some pullback in growth, or some moderation in growth at least. And copper demand, is likely to start reflecting that. I think that's probably likely to start coming in or start being felt a bit more keenly in probably the late part of 2022 and maybe into 2023 as well. On a long-term basis, there's still strong optimism there for copper demand. I think in the medium term, the green revolution really is the main driving force, but in the medium term it will be the power grid and renewables that are really driving that. And perhaps in the second part of this decade, electric vehicle demand plays a bigger role as well as the scale of that kind of ramps up a bit more significantly. Now, looking at the supply side, copper market's been very wary of disruption to Russian copper supply in the short term because of the self-sanctioning by consumers, traders, logistics firms, for example. But the geopolitical event risk is very high around this. It's very headline-driven. It's a very fluid situation, so it's very hard to gauge what the exact impact on supply is going to be in the short term. However, underlying all that, there's this expectation for strong mine output growth globally this year and next year. Macquarie seeing 5% in 2022, just under 9% to 2023. Really driven by mine output in Chile and Peru. That's still kind of recovering to some extent from the pandemic. You've got mine capacity additions from new projects and existing mines, and there's kind of a group of those that are really looking to come on stream in the next couple of years. And you're already kind of seeing that impact of improving mine supply and concentrate availability and treatment charges. And even in the last few weeks, they've jumped up quite sharply. That's going to feed through to refined copper output. Bloomberg is seeing China refined copper output up 4% this year. Now, in the long term, particularly beyond 2025 into the late 2020s, the project pipeline for mines is going to thin out quite significantly. That supply growth isn't going to be able to be sustained, and the hurdles to padding out that project pipeline and adding to it and and putting new projects into that system and into that process is made a lot more difficult because of the now far more strict political, regulatory, environmental hurdles to bringing new mine capacity online. And you have the drought in Chile for the last 10 years, the issues around water scarcity. That's all going to frustrate efforts to develop sufficient new capacity and really push the timelines for that out beyond, I think, what the market really needs. Now, having a quick look at inventory is a point I want to make. It's my view that it's, in terms of where global exchange inventories are at the moment, I think we still maintain some limited capacity to absorb some further supply shocks without an extreme scarcity pricing reaction. And I think, inventories are historically subdued for the time of year, that's very clear, but I wouldn't say they're overly depleted in any particular region in the same way they are for some of the other base metals at the moment. We still have stock in Europe on the LME, for example. We still have visible stock on COMEX in the US. So low stock levels are a bullish market indicator, of course, but I don't think they're at critical levels right at the moment where you would suddenly see supply prices exploding because of concerns about lack of material. Adding to that argument, I guess Shanghai Futures Exchange stocks, they have declined in recent weeks, and that's really been counter-cyclical against that usual seasonal trend you see of restocking throughout the kind of late Q1, early Q2. However, I think you've got to remember that China still retains this ability to auction its national stockpiles to the physical market. If domestic inventories hit very critical levels or prices get to very extreme levels where it starts causing their manufacturing sector a lot of difficulty. So I think on both counts, there's still a buffer there. There's still some kind of checks and balances on the inventory situation being such that you would get a really extreme price reaction, I think, at least in the short term. Now, in terms of the overall outlook for the market, I think the consensus expectation is for a broadly balanced copper market this year versus a deficit of around 500,000 tonnes in 2021. Surpluses may develop from that in the coming years because of that growth of mine supply I mentioned, because of the growth risks that perhaps could dampen demand growth somewhat. But beyond 2025 or mid-2020s, we may see deficits re-emerge because the green revolution demand starts to play more of a role. You start to see more constraint in terms of thinning out of that mine project pipeline. I think in the very short term, as a final point, I think it's very difficult to judge what price direction will be for copper. I think the overall inflationary environment that we are still in is still supportive for commodities generally and for copper. But I think on top of that, you have this very volatile, headline-driven response of the market to, as I mentioned, the LME liquidity issues, to the Russian situation, to the COVID situation in China. Not very easy things to predict, quite binary event risks in some instances, and that means that it's very difficult in the short term to be confident about where the market's going. But certainly, probably medium term, overall easing prices because of that more balanced market and growth risks, followed by later half of the decade, maybe we start to see deficits and some fresh emergence of price support and stronger price support there as well.